Welcome to Chapter 7, Part 1, where we'll explore financial assets and strategic equity investments in accounting. Financial assets are contracts that promise future cash inflows to a company. They represent valuable rights to receive money or other assets. Let's start by understanding the fundamental concept of financial assets. A financial asset is a contract that promises future cash or other inflows to the company holding it. We record a financial asset on the balance sheet only when we expect to receive future economic benefits from it. The key formula is financial asset equals a contract plus an expected future inflow. The term contract is key because it means there's a counterparty that owes the future inflow to the company. Companies can make two main types of investments: strategic and non-strategic. Strategic investments aim to control or influence another company, while non-strategic investments are made for other reasons, like earning returns. Strategic equity investments are made specifically to exercise control or significant influence over another company. Non-strategic investments focus on earning returns through dividends or interest, without seeking control. Strategic investments are always equity investments because you need ownership to exercise control or influence. Non-strategic investments can be either equity investments like stocks or debt investments like bonds. Strategic investments are classified based on the level of control or influence the investor has. We classify strategic investments into three categories based on voting power: subsidiaries with over 50%, associates with 20 to 50%, and investments with no significant influence below 20%. A subsidiary is a company controlled by a parent company, typically when the parent holds more than 50% of the voting power. An associate is an entity where the investor has significant influence, but not control, generally with 20 to 50% voting power. When a company controls a subsidiary, it uses consolidation accounting to combine financial statements. When a parent company controls a subsidiary with more than 50% ownership, they combine their financial statements through consolidation. Consolidation accounting means the parent company combines all assets, liabilities, revenues, and expenses of both entities into one set of financial statements. The consolidated statements present the parent and subsidiary as if they were a single economic entity. For associates where the investor has significant influence, we use the equity method of accounting. The equity method is a systematic approach to accounting for investments in associates where we recognize our share of their earnings and losses. Step 1. Record the initial investment at its cost, which is the purchase price paid. We debit the investment in associate account for the cost of the investment. Step 2. The investor recognizes its proportionate share of the investee's net income or loss on its income statement. We increase the investment account by our ownership percentage times the associate's net income. Step 3. Dividends paid by the investee are treated as a reduction of the investor's investment account, not as income. We decrease the investment account by the dividends received because they represent a return of our investment. Let's work through a detailed example to see how the equity method works in practice. Suppose investor company purchases 30% of associate company for $300,000. The investor purchases a 30% stake for $300,000 cash. We debit investment in associate for $300,000 and credit cash for $300,000. During the year, the associate company earns $100,000 in net income. The investor's 30% share of this income is $30,000. We debit investment in associate for $30,000 to increase it, and credit income from associate for $30,000 on the income statement. The associate then pays a total dividend of $20,000 to all shareholders. The investor receives 30% of this dividend, which is $6,000. We debit cash for the $6,000 received, and credit investment in associate for $6,000, reducing the investment account. The ending balance in the investment account is $300,000 plus $30,000 minus $6,000, which equals $324,000. It's important to understand the difference between debt and equity instruments for proper classification. Equity represents ownership and gives control or influence, while debt represents lending money without any ownership or control. Equity investments like common stock represent an ownership stake in a company and can give voting rights. Debt investments like bonds represent lending money to a company in exchange for interest payments and eventual repayment. Remember, debt investments do not give you any ownership or influence over a company's operations. There are several special considerations when applying the equity method. If the purchase price exceeds the book value of the associate's net assets, we must amortize this excess over time. We must eliminate after-tax, unrealized profits from transactions between the investor and associate to avoid double counting. The carrying amount of the investment is also affected by the investor's share of changes in the investee's other comprehensive income. The investor records its share of the investee's non-operating income separately on its financial statements. Let's review the key concepts about financial assets and strategic investments. Financial assets are contracts that promise future cash or other economic inflows to the holder. Strategic investments are always equity investments because you need ownership to exercise control or influence. For subsidiaries where you have control with more than 50% ownership, use consolidation accounting. For associates where you have significant influence with 20 to 50% ownership, use the equity method. Under the equity method, increase the investment account for your share of income and decrease it for dividends received. Mastering financial assets and strategic investments is essential for accurate financial reporting and analysis.